Welcome to our video about support and resistance. And when we talk about support and resistance in trading, what do we mean? Support and resistance is a concept that helps us to identify important price turning points. So those are areas, price levels where the price has shown a reaction in the past or even completely turned around. And the idea is that because we have seen a reaction from a specific price level in the past, we can estimate that there's a higher likelihood in the future that we're going to see a similar reaction. How does it look on a chart? Here I have drawn some, as we would say, support resistance zones. So those are turning points, right? The market is moving up, something is happening in here, and then the market is turning down. And then the next time the market comes to the level, we are seeing another reaction. And then even if we get above this zone and come back from above, then you can see often we are seeing similar reactions just in the opposite direction. And this is very common to see. Here you can see we have a level again where the market is moving down from. We're coming back into it. We see some reaction and then also from the opposite side. And this is a pattern that's going to repeat itself many times. Why do we have to learn about this? Why it's important? And I mentioned it in our previous video about candlesticks. The goal with chart analysis is always that we try to identify situations where we can predict what may happen next in the future. And support and resistance, just like candlesticks, are concepts that allow us to find such situations. Even though we are not going to be able to predict what's going to happen 100% of the time, of course, it may just be a very small edge that allows us to estimate what may happen in the future. It is still very important. And what we're going to do in the video today is that I'm introducing a lot of different concepts when it comes to support and resistance. We're going to come back to this concept of support and resistance many times during this course, so it's important that we have a good foundation. First of all, let's come back to the concept of turning points. As I said, support and resistance describes areas of previous turning points. And ideally, we would like to have two turns in the past to mark a valid zone. So how does it look? Here, for example, this is what we call a resistance area. A resistance area is where we are seeing moves lower from. So the market is coming into this specific price level and it's moving lower. And then it's coming back and it's moving lower again. And it's coming back multiple times and moving lower again. If we would extend that, by the way, you can see the market would even respect this level from above. And we call those levels support. Support is an area where the market moves into from above and then moves higher from. And again, here, the market comes back into this previous area and then moves higher from, and also here. And this is what we will call a support, and this is what we call a resistance. And the idea is that once we're able to define support and resistance, we would plot them in the future and use them on our charts. And whenever the price is coming back into such an area, we will start looking for specific clues as we build our toolkit, as we will get to know more of the concepts and tools that allow us to find good trading opportunities. Support resistance will come up many times because there we can often find good trading opportunities. And another concept that is very important is the flip. I kind of already mentioned it a few times, and we'll often see that support turns into resistance and vice versa. It's a very common occurrence, and we can use this concept for various ways, as we will see later. Everything from breakout or entry timing all the way to stop loss protection and stop loss placement. This is how it looks on the chart. So we have an area of support, right? The market moves into this area, moves higher from. We come back into this area many times and the market moves higher from it. So we have a clearly established support level, and then the market breaks through the level. But when we come back to the level from underneath, you can see now support turns into resistance, and we can use that. So we would extend the level going forward because there's a high likelihood that we're going to see something like that in the future again. Another example, we have a key level here. The market moves into the level, turns higher from, then we break it, and now it becomes resistance. And then once we're above it, it becomes support again. So the flip is a very common behavior. Here, another one. We have a established area of resistance multiple times, and then you can see we come back into this area from above, and now it becomes support. Resistance turns support, and then we're going to use that for entry timing later to find good trading opportunities. How do we draw zones? And generally it's okay to cut through a candlestick wick. That's the question that usually comes up First, can you cut through a candlestick body? Can you cut through a wick? I would not recommend to cut through a candlestick body when drawing your levels, but it may be okay to cut through a wick. So when it comes to getting started with support and resistance in the beginning, it will be not as easy, but it's a very simple concept. So after you've been practicing this for a while, this will really become second nature. And how I got better at it is just to pull up charts, random price charts, just scroll back, doesn't matter what time frame, doesn't matter what market, and try to find support and resistance areas. And then after you have done that for a few dozen times, you will be able to look at a chart and very accurately estimate how to draw levels. A good starting point and an idea how you could get going is that you mark turning points. This is how you start. You can start by just marking turning points. So here it seems like there's an area where the market moved lower from. Here we have some support. Here is a clear turning point. Here a clear turning point, and so on and so forth. So that would be the first step. Then we just gonna draw our horizontal levels. Don't worry about how it's looking, just draw your levels through all of the turning points that you have marked in the previous step. And then in the next step, we can revisit every of those lines and see, do they actually make sense? Are they valid tools? And then you can see the green ones I think we can keep. So this one looks good. You can see the market respected it many times as resistance here, here, and here. Here as well, you can see it was resistance here, and then here the market is still respecting it. This is an example where I would say this is not a good level to have anymore. Here we have a turning point, but that's really the only time the market reacted to this price zone. Right here, the market didn't care at all. Here as well. Contrast, here we have a good turning point. Of course, the market didn't pay too much attention to this turning point here, but then afterwards we have a very nice reaction. And why this is not a problem, we're going to come back to this in a moment. This is what we call a trap. Here again, this is a turning point, yes, very important one, but afterwards the market never paid attention to this turning point again. So just because you have a very strong turning point in the past, it doesn't mean automatically that this is going to turn into a level where the market is going to show you a reaction in the future. That's why I said it's important that we always have two turning points at the same level. That really makes sure that we're only looking at important and correct support and resistance levels, such as here, support becomes resistance. Resistance becomes support. And you can see here even as well. So this is how you could get started. It's a very simple exercise, but I would really recommend that you do this as many times and as often as you really can in the beginning. And you will see after a few days, few weeks, this will become really, really easy and second nature. How we're going to use support and resistance is manifold, but one way to use it is that we have our support and resistance drawn up, and then we look for other confluence factors, other clues, other signals. So for example, just because we have only studied candlesticks for now, what we could do is that we have a resistance area. Here, for example, we have a turning point. The market is coming back to the area, and then we have a pin bar. So that would be already two confluence factors. One confluence is the resistance, the other one is the pin bar. And as you will see later, as we develop our toolkit, we get to know more signals, more tools, more concepts, is then we can build much stronger trading cases where we may end up with 3, 4, 5, 6 confluence factors, 6 signals that are all pointing towards one specific thing happening in the future. So what we could say now is we have a resistance area and a pin bar. A pin bar is a rejection, so those are two things that would indicate potentially more selling. So this would be a spot where we could start looking for selling opportunities. We could go down to a lower time frame at the same area, and here again, even on the lower time frames, first of all we have deceleration, right? Remember, the large candles turning into smaller candles, suddenly we have red candles, we have the pin bar. So we have a few things that are all pointing towards this is an area where more selling is likely to occur. And you can see this is what happens afterwards. This is where we left off. And we estimated that at this point, because we know there's a resistance at the top, the market had problems breaking above it in the past, and we have the pin bar rejection. Those are two very strong selling indications. Context, another important thing. I will come back to this probably in every video, so get used to it. And it's really the key for professional and profitable trading. We can ask ourselves, where is the support and resistance level in the broader chart context? Something that we did with candlesticks as well, remember? So here we have a strong support level. And what has happened previously? Previously, the market was selling off very strongly, right? As you will see later, we would classify this as a mature trend. The trend has been going on for quite a while. The market has moved lower substantially. And what we will learn later is that the longer such a trend goes on, the higher the likelihood that there's not a continuation. Why is that so? We're going to learn about this in the concept and the module about trend psychology. But to foreshadow a little bit, obviously as the trend progresses, as the market moves lower, more and more traders will have more and more profits that they have not realized. They see their broker account go up, and they are then becoming more and more likely to take profits and exit their trades. And what does it mean? As we go lower, we have sellers in the market. And then as the sellers take profits, there are fewer and fewer sellers in the market. So there are not as many people behind this move anymore as there used to be in the beginning when it just was getting started. So fewer and fewer sellers are here, but also at the same time, as something gets cheaper, what happens in real life, in the real world? When something gets cheaper, more and more people are interested in suddenly becoming a buyer. Maybe at this point it was just too expensive. But now at this point, when the market is low, now it's very cheap and now more people are interested in buying. So at this point, we have fewer sellers because they are exiting their trades, and we have more buyers because it's low. And at this point, this would now indicate there is not as much chance that we could break to the downside. So the chances of actually this support holding and the market moving higher is a little bit higher, is a little bit greater. And you can see we bounced off the level higher, and what we did is actually quite the opposite. We broke the resistance that was established here. You can see we have a turning point here. The turning point is here as well. And then we broke above this turning point. So we are breaking the resistance and it's becoming support, right? The market is now suddenly turning higher away from this. So this would be a great trading opportunity to buy actually, even maybe down here, as we will see later. But at this point, it is way more likely that we move higher from this. And you can see this is exactly what happens. And afterwards, what happens? Previous resistance turns into support. So we could maybe even have two profitable trading situations and scenarios here. First, here on the breakout, when the resistance level is turning into support on the first time, or then in the second time as well. Those could have been a very interesting trading opportunity go long as well. And those are just a few ways how we can use support and resistance, as we will see later. Another concept which I really find interesting that many traders overlook, and it's pretty much in contrast to what general technical analysis probably also teaches you, is many traders learn that the more touches, the more turning points you have at a specific support and resistance area, the stronger it gets. But in my experience, and when we apply a little bit of common sense to it, I think exactly the opposite is true. And the more a level has been touched, the more a level has been used, the less the likelihood that we're going to see a similar reaction. Let me show you what I mean. So here we have a support level, right? We have a turning point here, turning point here, turning points here. And what I like to ask myself is, how is the market trading into a level? Because you can see I marked it here with the dotted lines, and there's a reason for that. The first time where the market moved into this turning point, we shot up higher quite a bit. Even the next time, the market came into this level and we shot up much higher. Of course, we were not able to break above the previous resistance, but there was a good reaction away from the level. The next time it looks a little bit different, right? We come into this level, but now the highest point that we can achieve after here reaching the support is here. So that's significantly lower. And then we come back to the level another time very quickly, and we get only a small reaction. So ideally, if you are looking for a support level and if you believe that there's a lot of buying going on, you would like to see a strong reaction. But if there's not a strong reaction, what does it tell you? It tells you that there are not many people who want to buy at this level. There were a lot of people here, there were a lot of people here, there were not as many people here, and there are very few people who want to buy at this point. And this is the weakening of a level. You can imagine it when you drop a ball on the floor. Every bounce of the ball is going to be lower and lower. And this is exactly what's happened here. Every time the market reaches the level, the bounce and the effect is a little bit less strong. Then we break below this level. and then the new downtrend unfolds. And we will use this concept later to find very great breakout opportunities. We call this in trading a breakout trade. We have a level, a support level, and then we break out of it. So the breakout strategy or breakout strategies in general are quite popular in trading because you can often catch very strong trends afterwards. Another example here, we are in a bigger picture uptrend. So we are in a market where in the past we have seen a lot of buying. Then the market is going sideways for a while. We have a resistance level at the top. We have kind of a support level at the bottom. But the key is here. How is the market trading into the resistance area? And again, every time we see a little bit of a less strong reaction, especially here in the last part. This is here really the key. This is what I would call, later we will observe that, it's called a lower bounce. We touch a resistance level and there's almost no reaction here. Whereas previously you have strong selling, a lot of selling here. Now there's nothing at all going on. And contrast, we are then seeing right away a very strong bullish candle. This is the largest green candle that we have seen. Probably, yeah, here was the last time after the last breakout. So this is a very strong signal of buying, and then you can see more buying is going to come. And how we trade it into the resistance level, if we don't see strong reactions away from it, that's a very, very important piece of information. Another example here, we have a very strong turning point here. The market rallied higher from it after moving lower very, very strongly. So clearly, if the market goes from selling off vertically, it's dropping almost vertically to then moving higher. Something significant must have happened, right? A lot of buyers, but also probably everybody who sold here now suddenly had massive profits and they were taking the profits. They were realizing the profits by exiting and getting out of the short trade, which contributes to more buying. And here as well, we have a lot of buying suddenly coming into the market, but something has changed here, right? There's no reaction. The market is not able to get away at all from this zone. So clearly, it's very different what we are seeing now than what we have seen in the past. In the past, this was a very strong buying level, but at this point, there's almost no buying going on. And the price is actually very strongly pushing into this zone. You can see if we look at this area, it's so far away from where the price was previously after reaching the support area. So clearly, this is a very, very strong signal for more selling to come. And you can see again, we have the breakout and then the market moves lower afterwards. Traps is a very important concept. It's one of my favorite concepts. And later we have a complete dedicated trading strategy to a trap. And a trap is occurring at previous support and resistance levels. So what we have here is a resistance turning point, another turning point, and then here it looks like the market is breaking out of the resistance. We are moving higher. This candle here is the highest close that we are observing here at the resistance. But what happens afterwards? The market is completely reversing and the resistance breakout is not continued. So there's no continuation higher. Within the next two candles, we are falling back below the resistance, and you can see afterwards what's more to come, more selling to come. So a trap makes it first look like we have a successful breakout, right? So the breakout traders will now all be very, very excited because it looks like their breakout trade is unfolding, and then they're getting into a trade, and then that's the trap. The trap is when the market reverses on them. And that is then when the breakout traders suddenly have to exit their trade for a loss, and that is increasing the pressure on the bearish side as well. So traps are really interesting because there is a lot of market and trading psychology going on behind the scenes, and I've dedicated a whole module just for the trap. Good practice in trading is to look at your higher time frame and start drawing your support and resistance levels there, because higher time frame levels carry a little bit more weight. So I have a few exercises. And here we are starting on the higher time frame. And if you are on the higher time frame, I would recommend limit it to the last 3-4 levels that you can see. So here's the current price action, and then you could say, okay, we have a big level up here, we have a very mediocre, not super important one here. Here is something that has happened in the past. You can see to support, here a little bit resistance, here 2 support, here has happened something, and then here 1. And on the higher time frame, that's more than enough. And then we could go to the lower time frame, and you can see it very nicely describes the price action. And ideally, we can even go to another lower time frame. So we are now on the 1 hour, all the way from the daily, where we draw the lines. And you can nicely then see how it would have been an interesting trading idea to just trade from level to level. Though there are often good moves, and that's also where you have the bulk of your trend trading opportunities. So that would be another way to use support and resistance. Again, draw your higher time frame. You could even use your 4 hour as your higher time frame. You look for important levels, resistance here, the swing point, if I get it out of the way, here you can see that. Here a little bit of reaction, here as well, resistance turns into support, resistance turns into support. And then on the lower time frames, it really nicely describes the price action, and then it would be ideal for breakout trading, for pullback trading, also for target placement. And you don't have to get too crazy when it comes to drawing your support and resistance levels. That's something that you're probably going to experience as well. And we refer to this then often as paralysis by analysis, is that you are drawing everywhere levels, every turning point you are going to mark, and then you will end up with so many levels that it becomes really scary to look at your charts, because there are potential obstacles suddenly everywhere. And then you are not able to execute your trades because you are too scared and too fearful, because you believe that at every turning point, every level that you have, the market is going to turn on you. So in the beginning, I would recommend to limit it to 3-4 of the most important levels that you have on your charts right now, and that would be a good starting point. Here again, we're starting on the daily time frame. We look for 4 key levels, resistance here as well, and then that's usually enough. And then you could go on to your lower time frame, and what we're going to do later is then look for breakout opportunities, continuations, and we're going to trade from level to level. And that is going to be a very interesting approach that can make a lot of money. Another question that always comes up is, how far back do you draw your support resistance levels? How much do you zoom out when you look for levels? And in my experience is it doesn't matter. Even very, very old support resistance level can hold value for today, even if they are months old, sometimes even levels that are years old. They still carry weight if they have not been disrespected in most recent price action. So here, for example, this is a level that has been going on for 2 years, but you can see the market still seems to be showing you reactions around that. Here as well, this is a very, very long-term level. We have a reaction here, then a few months, we have another reaction here. And I would, because this has happened now a long time ago, many months ago, you could still keep that on your chart, because the market has not violated it. It has not broken through it without paying any attention to it. So this is still a level that we could have on our charts. And then obviously the question that comes up next is, when is a support and resistance level not valid anymore? When do we take it off? And what I would recommend is that give your level a little bit of a chance. Don't be too strict. So here you can see we have a resistance level here. We have a little bit of a flip. Resistance turned into support here as well. Then we come back to resistance, and here it seems like the market has violated the level. However, I would not take this level off. I would give it another chance. If we get a reaction the next time, I would keep it. If the market does something similar and just breaks through it, then I would turn it off and not use it anymore. Because something like that will happen quite often. You have a support touch point. Here we are not paying too much attention to it, and then we come back to respecting it, and you can see even in the future it's still respected. So don't be too strict with your levels and give it some time, because very often you will see that the market is coming back to respecting important levels.